Hi, Louis and I had a thought last week that we wanted to share with you our conversations about some topical thoughts and questions that we're getting from our clients and friends about the market, about what's going on in the world, and how that all ties into our positioning as a firm. Louis, I guess the question I'm getting most is, you know, people are getting nervous with what's happening politically, they're getting nervous at the end of a cycle, and the question that I'm hearing is, you know, are you going to cash? How are you getting defensive? What are you doing? And you know, we take a different view, and I know that, but maybe you can expand a little bit on our views of how we take care in times of volatility.
Well, for sure. Well, the easiest way to think about this, you know, Bill, I mean, big picture, typical business cycle is, you know, 9.5, 10 years, and we're 10 years into this cycle, so it only makes sense from our perspective to really think about, you know, have an eye towards safety. And so there are a number of ways we try to express that in the portfolio that we think are just a natural way to kind of approach market. And it really doesn't involve cash. It really involves having a better mix of investments that we think is going to be more defensive. And so there's at least 3 different ways this shows up in how we're addressing the markets. I mean, the first way, you know, is how the equity portfolio looks different. And so a good way to think about that, you know, there are at least 3 different things. The first is the risk that we're taking, and you can define that by a measurement of kind of beta. And so anyway, essentially the beta of our most conservative portfolio is basically about 0.72, 0.75. And
that's 100% equity.
That's 100% equities, yeah. So what that means is that on average, that portfolio has 25% less volatility than the market itself. So, so that's kind of the first thing. And in terms of how we've done that, because again, because we're doing our own proprietary research, one of the ways that you know, we're different from a lot of firms is that you know, we will do it with a different kind of security selection. And so the way this will look, for instance, when you roll it up, say 22% of that model portfolio, the most conservative one, is in consumer staples. And so these are things that people need on a daily basis. And so that's there's much less cyclicality to that if you look at it in the past. And so that's a good way, we believe, to create more defensiveness in the portfolio. A couple of other things that we've chosen to do, of course, having a gold-related sector, we've chosen to express this through a lot of the gold royalties that we've written about, for instance. And those tend to be, they have acted very defensively in the past because one of the, gold tends to do well, and many times historically during recessions, because the Fed is often cutting interest rates to try to bolster up, you know, the stock market to create liquidity for people. And of course, gold in the past has historically worked very well in that instance. And so, for instance, in that most conservative portfolio, that's basically 8% of that portfolio.
So, Louis, I guess what I'm hearing, and I actually know this, but I want to share my thoughts, is that you have the ability to remain fully invested in times of volatility. If you adjust the mix of the underlying securities, you can be more defensive, more aggressive when it's most opportune for you. Again, assuming your allocation is tied to your risk tolerance. So we're not in a position where we're trying to time the market to go in and out to cash. We're simply adjusting the pieces of the portfolio into areas. Consumer staples, I think, is a great idea. If you think about it, just simplistically, when times are tough, people are going to buy the things they have to use on a daily basis, and the discretionary items may be the things that they save for some point in the future when the economy gets better. So I think the biggest picture for us is that you can remain fully invested according to your risk tolerance. You can still have your money in equities to the extent that it matches that risk tolerance. But if you're more defensive, you can weather the storm of volatility. How are we doing it on the fixed income side, Louis? Why don't you talk a little bit about that?
Well, frankly, that's a great question, because I think one of the best risk mitigation tools we have, bar none, is being active in the treasury market, investing in the treasury market. And this is a market that a lot of people have been scared of for the last few years because growth was robust, and there were a lot of people that felt like interest rates inevitably had to go up. Of course, that has not been the case in terms of what's taken place in the markets these last few months. You know, so one of the things that we think about in terms of risk management is we want to get, you know, long the solution, right? And so because the biggest risk to an equity portfolio is the kind of common disaster of a recession, because if stocks follow earnings in the long run and earnings go down in a recession, stocks go down. So one of the easy questions to ask yourself in terms of trying to develop a portfolio that's more resilient is to own things that actually will do well in those periods of time. And the easiest things that is U.S. Treasury bonds. So we think they're a huge part of our allocation because they do a few things. First is They're one of the most liquid markets in the world, which means we can, this is a very important thing for us because of the second reason, which is some of the higher quality, longer dated bonds, such as say US government 10 or 30-year bonds, have actually in prior recessions appreciated in price because what the market is doing very quickly is pricing in interest rate cuts. And so again, this philosophy of kind of getting along the solution, it's kind of insurance that pays us to own it, and what we are trying to do philosophically is to set up an opportunity where we can own these defensive instruments through a down cycle. In an ideal world, as they have in the past, if they appreciate, our goal is to be able to sell something that's worked, to buy something that hasn't worked, and so we use this as kind of a risk buffer, and we think it's a far better idea to do that than say pile into cash, because no one has a crystal ball that's good enough to sell at the top and buy at the bottom. You have to move it moderately.
And with yields on cash being very low, I like the idea of getting paid while we wait.
Sure.
So not only are we getting more defensive, we're entering a very liquid, stable market that has an opportunity to appreciate, sort of counter-cyclically to the equity markets, but we are going to get that yield along the way. Yeah. So I would love if my insurance company would pay me while I wait to use it, but I don't think that that really works out for their business. But from a client portfolio perspective, it's a great alternative to sort of saying, hey, I'm going to take my money, I'm going to get in and out of the market, try to time it in and out.
That's right.
This gives you a yield, it gives you some positive performance while you're hedging, if you will, against the risk of volatility in a time. And I think one of the things that we share on often with our families that we work with is that, it's like turning a dial. So as we get close to the end of a cycle, we're gonna dial some of these more defensive things up, but that doesn't mean you stay there. So it's something we can adjust, and it's a liquid market, and it gives an opportunity to keep clients in a position where they can profit during times of volatility very safely.
Yeah, well, there's a great investing quote from Warren Buffett says, the key to success is to be, fearful when people are greedy and greedy when people are fearful. And so again, 10 years into a cycle, as we are right now, a lot of people have forgotten, what the damage that a down cycle can do. We of course don't. So we incorporate that thinking on a forward-looking basis, trying to have the portfolio set up differently.
Yeah, I always like using the phrase, the Buffett phrase, I guess this is a phrase I heard from someone, is we're not trying to get the last squeeze of juice out of the orange in this cycle. I'm perfectly happy to be defensive a little early, and I think your famous line is panic early, beat the rush.
Panic early, beat the rush.
Doesn't mean to go to cash, but if you get defensive early, it's not going to hurt you in the long run.
Well, when if you're panicking when everyone else is panicking, it's been my experience that people panic because they should panic, and it's scary. And so if we're going to get ahead of that and not get run over by that, then we have to sell when the sky is blue and everyone feels awesome about things. And so, we really have endeavored to try to keep the portfolio turnover low, because frankly, the more you're touching the portfolio, there's friction cost in that the client ends up ultimately bearing, whether it's taxes or trade costs. And so, we want to hold our investments as long as possible. But what this means is we have to do things very gradually.
So I guess to sum it up, our opinions are that getting defensive doesn't mean going to cash. It means adjusting the positions in the portfolio. There are equities that you can still own and yet be defensive.
That's right.
There are fixed income instruments. The Treasury, as the example you used, is a great way to mitigate risk and also have some yield along the way while you're through the cycle. And if you take those defensive measures in a portfolio and you build your portfolio according to your risk tolerance, you're going to feel much better through the ups and downs of the cycles.
Yeah, no, that's definitely true. And remember, if you take a look at it anyway, say the last 3 or 4 cycles, the up cycles tend to be 9, 10 years, down cycles kind of 2 years. But it's up the escalator and down the elevator.
Yeah, I mean, the sort of the recovery or the growth periods always seem to be long and gradual, and the downturns tend to be short and sharp. So if you have the ability to be defensive and limit that downside, long-term investors will do better if we can limit downside.
Well, that's for sure. But a key part of what we're doing on the risk management side, right, is like we mentioned, for instance, how our most conservative model portfolio has a much lower, say, beta, a lot less risk on that measure than the market. When we're taking these steps to make things defensive, if we're too premature in that, there's no question that portfolio should lag the market.
Sure.
But we're making a management decision based on our interaction with clients that when we talk about what we're really focused on doing, it's really wealth preservation. And so if we have to make a choice in an uncertain world in terms of reaching, like you said, the last squeeze of the juice, we would just not choose not to go there. But we have to talk about that. Clients have to understand that's a big part of our risk management framework.
I had the opportunity to shift gears a little bit. I had the opportunity to spend some time in Washington visiting with some politicians, talking about topical items, things in the front of mind, front of the news today, and maybe have you comment on a couple of those. We have a trade, some people call it a trade war, some call it a long negotiation, but our efforts with China seem to be dragging on, sort of with that supply chain from that perspective of trade. And then we have sort of new tensions popping up in the Middle East, specifically around Iran. How, if at all, does that affect your thinking on either of those topics with regard to your allocation and the risk that you're taking?
Well, the future, of course, is always uncertain, although it certainly feels like the burden of that is even higher now in terms of a lot of things that were foundational are kind of coming under question now. And so, again, we think the biggest takeaway for us in this is to set up to be defensive kind of, early on, because I think the scope of outcomes is far greater now than I think anybody would have assumed even a couple of years ago, right? But in terms of again, because we're doing our research internally, we believe that one tool we have to do that is not just say asset allocation, stocks versus bonds, but a bigger thing is how to think about, is there a security you can find that if something bad happens that might hurt the rest of the portfolio could actually help. And so, for instance, the defense sector is one in which we've invested over a period of time, and if you think about it, it's a sector that can profit from if tensions really rise quite a bit. But I definitely think, again, the different risk metrics that we look at with a portfolio, we believe that we've made decisions along the way to kind of build in that defensiveness. But yeah, I mean, it's quite a bit of uncertainty. I mean, the markets are always like that, but I think some of these foundational issues we're going to be grappling with for some time.
Another sort of global economic factor that I think is weighing especially heavily on people in Europe is the whole idea of Brexit. This morning, Theresa May, Prime Minister, announced that she's going to be stepping aside after being unsuccessful in getting her Brexit package through, which would indicate a more populist tilt to what the voters decided back when Brexit was approved. How, if at all, is that going to affect, in your mind, in your opinion, sort of what's going on in Europe with global credit and trade?
Yeah, well, look, I think you could argue, Bill, that these forces have been at work for some time. Because if you take a look just in the rearview mirror, last 2 or 3 years, or frankly, the last 6 or 8 years, right? The U.S. markets have wildly outperformed almost any market in the world, basically. And I think a big part of that is, frankly, kind of this idea of capital flight. Where capital tends to go where it feels safest and what it believes is the best reward. And frankly, when you look at the institutional foundation of Europe, which is literally splintering with Brexit, it's easy to look at that and feel uncertain and feel like maybe your money could be rewarded elsewhere. And then, and frankly, Asia's been a hotspot for growth for a long time. But again, if this trade framework, like you were mentioning, if that's changing, then like that former export platform that profited that country, that region for so long, could be going away.
Do you see a shift in that, to just jump on your topic, do you see a shift in supply chain? So recently I had a conversation with someone in the textile industry, and the discussion was around shifting production from China to Malaysia. And I've read others that their companies are shifting supply chain to areas like Vietnam. Because it is singularly focused on China, do you see that happening, or will it be sort of a contagion that sort of crosses over to other areas?
That's a really good question. I mean, I think, well, as you know, Bill, I've been investing professionally for 20 years, and
getting old.
I'm not going to talk about that, but it's been like 20 years, and one of the things that I've done a lot of is investing in cycles and cyclicality, and so I guess, and this is like hundreds of cycles within that little channels, and so what I would say is that my experience is that when things change, cycles have a pattern, and that they overshoot, they go longer than you think, for higher than you think, and then they reverse and they go lower than you think and longer than you think. And so what I would say is my framework, or when I look at this, and again, why I think we're set up defensively, is I could argue, and I have argued, that if you take a look at a lot of the geopolitical framework that held the world together after World War II, this is the WTO, it's the UN, it's NATO, it's the free movement of people and trade. All these things are clearly in retrograde now in terms of people's comfort with them, and so I understand that change is taking place, and for reasons that are rational. But one of the things you have to look at that is it took us 70 years to get to the point where we are now, and so I'm very open-minded to that framework changing dramatically. And so I guess, from my perspective, again, this is kind of why I believe it's wise to be set up defensively, because I could see this change for many, many years. I mean, I don't think it's a small change. I think it's a big change.
To summarize Lewis's points, or our views on the geopolitical tensions and changes happening around the world, is we feel they're very interconnected with each other, and we see a sort of a global change ahead. That doesn't mean that we're going to panic. It simply means that we're going to have to do research to determine where we can invest safely and opportunistically on behalf of the families that we work with. So understanding what's going on in the world is very important, because it gives us, as part of our data set, the ability to apply our investments in an area where we think is going to be safest and most beneficial for our families.
One of the things that's really been foundational for the firm is our belief that it's critical that we communicate with clients and they understand how we're thinking about the portfolio and the moves that we're making. And so one of the things that's really helpful, that I hope people find helpful, is we have a strategy piece I write every couple of weeks. It's called Trends and Tail Risk. We have another piece that comes out about once a month. It's written by our Director of Research, Zev Abraham. Risk on, risk off. We really try to use these to incorporate changes in the portfolio and what we're looking at and thinking and worrying about in the markets. And so if you haven't had a chance to do so, please avail yourself of that. You can also pop us an email, give us a call. We'd love to get you on the distribution list so you know our thoughts.
Thank you for taking the time to watch today. We hope that you found the topics helpful as you think about your portfolio. Lewis and I are going to be having these chats on a quarterly basis and sending them out, and they'll be posted on our website. If there's a topic that you'd like us to discuss in a future video, please feel free to email us at info@cwafgi.com. Have a wonderful day.